Once it was gold. Once it was real estate. And now it is the stock market. Ask a man what he does for a living and he may hesitate. Ask him what stocks he owns and suddenly he becomes a philosopher. Today we observe a curious group of people. People who say, with great confidence, I'm into the stock market. The first type is the casual investor. He will tell you he's investing for the long term. He will say this while checking his portfolio every 6 minutes. He doesn't remember exactly why he bought the stock, but he remembers the day it went up. If the price rises, he is a genius. If it falls, it was never a serious investment anyway. He says things like, yeah, I'm just holding. Markets fluctuate. I'm not even worried. And yet, his heart rate is directly correlated to the S&P 500. Then comes the new expert. He made money once. This single event transformed him. Suddenly, investing feels easy. They start sharing opinions, giving advice, explaining what's going to happen next. Yesterday, he asked what a stock split was. Today, he explains macroeconomics. He speaks fluently in buzzwords: undervalued, strong fundamentals, market sentiment. If you ask him to explain further, he will say, it's complicated, which is expert language for, I watched a YouTube video. Next, we meet the panic philosopher. When the market is up, he is calm, logical, and disciplined. When the market is down, he suddenly understands the fragility of civilization. A small dip becomes a warning. A correction becomes a prophecy. He says, this is healthy, while selling everything. Then, after selling at the bottom, he waits, patiently, for the market to recover without him. The data lover. This investor believes the answers are in the details: charts, indicators, models. The idea is simple. More information means better decisions. They are drawn to charts, numbers, and patterns, candlesticks, moving averages, ratios, models. To them, data feels safe, objective, reliable. If something goes wrong, the answer must be missing information. So they collect more indicators, more historical comparisons, more spreadsheets. And information helps, but it doesn't remove uncertainty, because the market is influenced by people, and people are unpredictable. The trend chaser. The trend chaser does not invest, he hunts. He arrives late but with enthusiasm. When everyone is talking about the same stock, it's hard to ignore. He buys what everyone is talking about, because if everyone agrees, it must be safe. Trend followers buy what's popular. They hope momentum continues. Sometimes it does. Sometimes it doesn't. He does not ask, what does this company do? He asks, is it still going up? When it stops going up, he disappears, only to return for the next trend. The disappearing crowd. When markets are rising, everyone is present. Timelines are full. Group chats are active. Opinions are everywhere. People talk about stocks at work, at dinner, online. But when markets fall, something changes. When markets fall far enough, the crowd thins. Accounts go quiet. Experts vanish. Silence replaces certainty. This is when the market speaks most clearly. And finally, there are the quiet ones. They don't talk much. They don't predict. They don't panic. They understand something rare. The market does not reward excitement. It rewards patience. They know most movements are noise. Most opinions are guesses. And most confidence is performative.